Welcome to the Value Investor TV podcast. This is the podcast to help you grow your wealth and become financially independent. My name is Becco and
Hari.
welcome to our podcast.
Becco didn't mess it up this time.
I know. I didn't say my name is Hari and Becco or Becco and Hari. I don't know what I said last time, but I did mess it up. All right. This is episode 49. As you saw from the title, we're going to be talking about Lyft. It's been on the news for the big IPO that it just had 2 weeks ago. Yeah, 2 weeks ago as of recording today. So interesting company. I'm sure a lot of you have used it. I'm a big fan of it as a customer, and Uber as well. But let's see.
Because the investors are subsidizing your rides.
So let's uncover exactly what they're doing underneath the hood.
Yeah. So I think most people are, looking at the title of the podcast, Value Investor TV, and then looking at why are we talking about Lyft.
Sorry.
So
should we talk about disclaimer real quick?
Yeah. Actually, let's do that. Well, at the end of this, if you decide to buy Lyft, then you clearly didn't listen to what we were saying. But
that's not our position to.
Right. Yeah. But the what we talk about here is how to educate yourself on the concepts that drive value investing. So understanding businesses and understanding how the business translates into a value for a company. So we do that for education and entertainment purposes. Our goal here is not to tell you what to buy or sell. Our goal is to kind of educate you on how to think about these processes, and then you make your own decisions, because we are not your financial advisor, nor do we know your specific financial situation.
Yeah, that's great. All right, let's move into our discussion of the day. Lyft.
Yeah,
you were saying. So
I think what I wanted to really kind of highlight here is that when we're talking about a company like this, one of the things that was pointed out to us, yesterday we had our normal value investor meetup here in town, and someone made the comment that the first time you investigate a stock, you may spend hours and hours of research, and at the end of it, you realize that you don't want to buy, right? So why we investigate and learn about companies like this is to understand, how different business models apply. I mean, this is clearly a new business operating in a different space, that's trying to change the way, transportation works for people. Sometimes they're right, sometimes they're wrong, right? But you don't really know until you pay attention to it. And I think the other part of this is it's very easy to be lazy and just read what the media gives you, right?
Yeah.
And the media is not always right. As our president frequently says, talks about, whether or not they are right, you have to make that judgment for yourself. And the best way is to go to the source, right? So start with the data. And I was very surprised when I read this, because I frankly didn't understand why this company wouldn't be profitable, right? They're just an app, right? And they sell an app to their users, and they ride. So let's actually talk about the business, and then we'll explain what kind of findings we had.
Yeah, those are really good points. Just understanding exactly what they do, lifting the cover, that's the fundamental value investing 101, right? Going to the source. So let's do that. Let's go down the checklist. And again, we've been touting this and saying to you guys all along, if you don't have the checklist, and for every podcast that we do in terms of analyzing companies, we follow our own checklist, Value Investors Checklist /template. So if you don't have it, please do reach out to us at info@valueinvestor.org, info@valueinvestor.org, or reach out to us on Twitter, Value Investor TV, @ValueInvestorTV, all one word. So let's go down the checklist here. The first question is, what does the company do? You should be able to answer this question in less than 2 sentences. So Hari, Lyft, what do they do?
So I'm not going to describe it in the way that the rest of the world would describe it. I'm going to actually use the words that came out of their S1. So
sure.
For those of you who are unfamiliar with how this works, so Lyft just IPO'd. So IPO means that it's an initial public offering. We had a whole podcast about it. So if you're not familiar, go back and kind of learn about that. And so what they're required to present is a prospectus for potential investors to understand, and that means that they have to do at least 3 years of financials if they have them, right? Most publicly traded companies have at least 3 years of operating history, and so and on top of that, they kind of give you like a roadshow of they go around to try and get a bunch of people to buy in. I'm curious how many people actually read what they do as part of that preparation, and how many of them just said, just take my money, right?
Yeah.
Because this was an oversubscribed IPO, meaning that lots of people bought in, and there wasn't enough shares to go around for all the people who were interested.
Mm-hmm.
So Lyft is started in 2012, and they call themselves a peer-to-peer marketplace for on-demand ride-sharing, right? And so I want you to remember that first part, peer-to-peer marketplace for on-demand ride-sharing, because that's not what they do, right? And it'll become very obvious when you start reading their financials. That's not what they do. They are, they talk about how much the average consumer, spends on this, and then saying that their big value proposition is that cars are only utilized 5% of the time. So their business is essentially, you have an app, I'm trying to go from point A to point B. I could call a taxi, I could take my own car, or I could call a Lyft on the application. So I say I'm here standing at this GPS location, and then a car will, show up at my, where I am. Somebody who is driving that will be has gone through the Lyft, background check and that kind of stuff.
Mm-hmm.
And then there is a pre-negotiated fare for that, because we know the distance when we start the trip, and then they take you there, and then you can leave a tip, and that's essentially how the business works.
Yeah.
So unlike their competitor Uber, they do not offer a Uber does other types of business. They have Uber Eats is probably the most commonly known one.
Yep.
But Lyft is calling themselves transportation as a service. So as a result of that, they've bought a scooter and bike company to offer on-demand scooter and bike sharing, what they call ride sharing, bike sharing. Well, it's not really sharing. What they're doing is, go ahead.
No, actually, I just wanted to drop a comment on that one. When I was in San Francisco for a conference, I actually was on one of these Lyft scooters.
Uh-huh.
As a customer, right? Just as a customer, it's very convenient. You just open up an app, and then you see a scooter down the street. You just, one of these scooters that have been kind of everywhere, like Lime is another one. These big scooter companies. Lyft is jumping into the bandwagon, and so they bought a whole bunch of little scooters. It's lying on the street. You just walk up to it, put your phone up there, and then like scan, and then put some numbers into it, and then boom, you're ready to go. And then once you're wherever you want to go, you go, and then you just drop it on the street. Sure.
And I've used Uber. I haven't used Lyft, but they're effectively the same thing, right? And it is convenient. Like you can, you go out for a night on the town, and you don't want to take a car with you because you're downtown. You Uber there and you Uber back. I've gone to many baseball games that way. Go Astros. And I want to make sure that, we're clear about this, that just because a service is, convenient, right, is not necessarily the, that's why we dig into this, right? If we went in and said, oh, I use it Lyft all the time, right? And that's the only research I do, it could turn out that the company hemorrhages money. And, so let's talk a little bit more about that, like how that business operates, because very much lots of people say it's very convenient. And one of the things that they talk about is, they say in this prospectus that demand will continue to grow as more people discover their convenience, the experience, and the affordability, right? So the idea is that you're going to use more and more rides over time, because that car that you own has cost you, people are spending $9,500 on transportation a year. If I just took a Lyft every day instead, I would save money, right? Because I don't have to worry about my gas, And then the other thing is they say is people are, and I've heard this parroted by very many media outlets, 5% of the car is in use and the 95% of the time it's just sitting in a parking lot. So their idea is, well, then you can use us instead, and then you don't have to worry about that 95%. Well, let's just think about this for 2 seconds, right? Because that is a really kind of silly statement, right, in a lot of ways. So yes, my car is in use 5% of the time, right? So let's say we got rid of all cars and there was just Uber and Lyft, right, to get around, right? So that's the driver owns the car and they come and pick me up, right? So we all have to get around. So at 2:00 in the morning, there's plenty of there's plenty of available cars, right? But at 7 a.m. and 5 p.m., it's rush hour. There aren't enough available cars, right? So
The surge demands.
there is an enormous amount of surge demand at certain times of the day, right? So your car is not in use, is only used 5% of the time, but what percentage of cars are in use between 7 and 5 p.m., right? And it's probably well over 50%, right? So that, that kind of, thinking is, this is how they're, telling you their business works, right? And I find it interesting that they say this kind of stuff up front. Because, there's a lot of fluffy things that you can say in your business, right? But they've introduced this company, and they've kind of already assumed that how it works, right? So let's move on to the competitive advantage. And I'm going to kind of explain to you what they say in their words is Lyft's competitive advantage. Because this is where I start getting, irritated. Because I'm usually irritated anyway, but more
That's
so.
true. Ladies and gentlemen, Hari's always there.
So they have a section called Why Lyft Wins, right? And so that's, why should you invest? Why should you be part of this, right?
Yep.
So why Lyft wins is that the first thing they says is they're a visionary founder-led company, right? Okay, fine. I like founder-led companies. That's, a good thing, right? The founders in this case didn't have enough control of the company, so pre-IPO they actually changed the structure of the business so that they owned all of the voting control, which I don't like. Culture and values, authentic brand, singular focus on transport, right? Driver-centric. And under driver-centric, they cite that they have 24/7 support, career coaching, education resources, car rentals. So I want you to listen to that and then listen to what the first thing that comes out of their mouth when they talk about the business. Peer-to-peer marketplace for on-demand ride-sharing. So if their business is peer-to-peer on-demand ride-sharing, right, that's an app, right? This is, I'm providing all of these services around this peer-to-peer ride-sharing, right?
Yeah, the entire infrastructure value chain to provide their mission.
Right. So, but I think what it is it's disingenuous, right? The way that you're presenting your business, right? We're talking about being open and honest and truthful, right? I'm slamming this company for a lot of different reasons, but I don't like companies that have, I want you to tell me up front what you do and be very clear about it, right? You're telling me in your why Lyft wins, you have these very soft metrics, right, that don't make any sense, right? Visionary founder-led company with culture and values. I don't invest in culture and values. I invest in companies that are going to do something that provides value to their customer, that provides value to me as the investor, right? So nothing they've actually said here is providing value to the owners of the business, right? They have very soft kind of fluffy things that make them their competitive advantage. Yeah.
Not to say that culture itself is not important. Culture is very important in companies, right?
Absolutely.
Yeah. Not to say that that's not important, but that is one of many things that you need to look at. And that shouldn't be the only thing that you say.
Right. And what they're clearly trying to do here is differentiate themselves from Uber, right? Uber has a terrible reputation with sexual harassment and all of these other things that are going on in their company. Yeah. So they're trying to differentiate themselves as we're the good guys.
Yeah.
Right. Now, I like good guys. I like to have my friends be good guys, right? But that's not how I invest, right? I invest in companies that do good by providing a service, right? By providing a service that creates value for their customers, they do good for the they good for the world, right? So the other things that they say why Lyft wins: multimodal platform, data-driven, personalized customizations, and so they're saying that we know when people are driving and that kind of stuff, so we can. And then they're pioneering autonomous vehicles, right?
Yep.
So none of these things are a competitive advantage over Uber, honestly, other than say their brand and their culture, right? They have a differentiated culture relative to Uber. But otherwise, I look at this and I say, competitive advantage, what competitive advantage do they have? So is it a brand moat? Well, I mean, yeah, there's Uber and Lyft, but can they differentiate themselves? Because at this point, we can't really can't talk about a differentiation without talking about Uber too, right?
Yeah, for sure.
So when you have the app, right, you have the choice of picking between Uber and Lyft, right? So what makes you pick Uber versus Lyft, right? And the other side of it is, why do the drivers pick Uber versus Lyft?
Yeah.
And the truth is that drivers don't. Most of them drive for both.
For both, yeah.
And then they pick up whichever one has fares.
Yeah. Like for something like for something like ride sharing platforms, right? It's a two-sided market where you have to have the customers, the users, but also the drivers to be on the platform as well, right? And so at least you need some stickiness on both ends. Right. But what we're seeing now with Lyft and Uber, I mean, I just took Uber or Lyft here. For me, I mean, the first thing I did in the morning was, okay, let me see which one's cheaper, right? Mm-hmm. If whatever is cheaper, I'm going to go with that, and then that's the same way for drivers too. So whatever is paying me more or whatever has more customers, I'm going to go with that over others.
So what you just said describes what kind of business?
The commodity business.
Exactly. Yeah. So there is no competitive advantage here, right? They have to compete on price.
Price is the only thing that is the only differentiating factor between the two.
Right, because you're going to get to literally in the same car, Uber versus Lyft, right? You're just picking the one that gives you the better rate.
Yeah.
Right? So it has no advantage in that regard.
In that regard, yeah. I also want to, I mean, this is something that my friends told me, and so one of our coworkers told me as well, is he said, I like to get on Lyft more than Uber because of the sexual harassment things. I don't support the way Uber is conducting business.
Sure.
And I think it's a fair argument. I think more power to him.
Right.
But at the end of the day, if you look at the numbers, that's not enough. I mean, that's not the culture. I mean, you said it well. The culture is a differentiating factor, but it is not enough to make a sizable dent in how they operate.
Right. And I think, we have about 7 years of operating history. They were founded in 2012, so let's call it 6. To see that they have, built up a business, we're going to look at their financials, because I think that's where this story becomes a lot more interesting, right? But I mean, what we've kind of broken down for you right now is, they quote in this, that they're providing a value proposition for, for their riders. That they're going to, you're going to use this service because they're providing you value, right? And so one of the things that, we talked about in the meetup last night, which I thought was fascinating and was well written, was, the cost has to be less than the price, and it has to be less than the value, right? So the value that you receive as the customer has to exceed the price that you're paying, right? Mm-hmm. But it also has to exceed the cost of providing that service, right? So that's where this is interesting, because I think the value exceeds the price for most people, right?
Yeah, for sure.
But the reason that it exceeds the
the
price is because the cost has been subsidized.
Yeah, right? It's interesting. It's shuffled, right?
Or I'm sorry, the price has been subsidized. The cost is still what it is, right? And so when we talk about that, right, you have to think about this as they have to compete on price. They basically are competing at a level that is being subsidized. So this is an arms race to see who can survive,
last longer
before they have to go in and with another business.
Yeah,
right?
I think it's interesting that you point out in that terms. It's like a war, right? Whoever is the last man standing kind of wins the battle. But if I think about that for a second, if let's say, for example, like Lyft went out of business and Uber just totally dominated them, Now the question is, do they at that point? Do you think they'll have the pricing power to elevate the price so that they can actually become profitable? You know what I mean?
Well, and so
like,
that's
yeah.
the thing is, like, their average ride is around $10 to $11, right? Based on their financials, it would sounds like they have to increase the price to about $15, $16, $17 per ride.
Yeah.
That's a little not, less comfortable, right?
Yeah.
Like, I'm willing to drop $10 here, $10 there to move around. When you start talking about $15 or $20, it becomes a lot more. You become a little more sensitive about, well, maybe I'll use public transportation,
Yeah.
or maybe I'll,
Just drive myself there.
doesn't mean it goes away, right? But then the value proposition is, I mean, the demand for this is very kind of,
Yeah.
How elastic is it?
Yeah.
Right?
I also think that, for example, if Lyft becomes a dominant player and they
Yeah.
have that pricing power because they are, quote unquote, monopoly,
Right.
I don't think they can actually truly establish monopoly because another ride sharing app will just pop out and then they'll undercut them with price.
Right. Or what I think will happen is, I mean, there's, the other side of this is there's taxis, there's, public transportation, there's other things, right? You have the option of alternative goods, right? One of those is using public transportation. One of them is using your own car, right? So for me, I take that to one of my contract jobs that I work. I would take Uber, especially when it was raining because I'd have a long walk in the outdoors. And when I started, Uber was like $7 or $8 to ride to the place that I was going. And then what happened was they started raising the rates and it became like $12, $13.
So it doubled.
And then I have to use it going back. So it's like, well, it's almost $30, and what would happen is because it was raining, they would surge price. And then I was like, well, then it's not worth it anymore, right?
Yeah.
And so I'll just take an umbrella and, suck it up,
Yeah.
right? So, I think people are very sensitive to this. Now, when you're, inebriated, it may be a different story, right?
Yeah.
That you may like, whatever, I'll throw money at this.
Sure.
But that's not how, that's not is that a sustainable business, right? Is where I'm thinking. That right now the revenue is very high because a lot of people see a lot of value. Right?
Yeah.
But I think, here in Houston, we had the rodeo. People would take Uber and Lyft in because they didn't want to pay $20 for parking. And then they would, taking it back,
Surge
it would be
price.
$30, $40.
Yeah.
And people are like, what the hell is this?
Yeah,
right?
yeah.
So, I mean, that kind of, thing is there's a very sensitivity to
the price.
to price,
Yeah,
right?
yeah.
And that's why you're seeing, I'm willing to look at Uber versus Lyft to see which one is giving me the cheaper price.
Yeah.
Right.
Exactly. Yeah, it's interesting. I mean, it's all about competitive advantage, and I think we've kind of dove in length to talk about the lack of competitive advantage with Uber ride or ride sharing business altogether, and Lyft in particular. So let's move on to the next bullet point, which is what is the company's long-term perspectives and runway for growth? Maybe kind of shine some light on perhaps what you think about the industry's like growth, the runway.
So I think there's definitely a percentage of the population who are highly interested in using Uber and Lyft.
Yeah.
Their kind of thought process is they mentioned that like 35% of their riders are not owners of a car, right? So they're using this as a primary means of transportation.
Yeah.
And 52% of their people are using Lyft to go to work, right? So it's a convenience. It's a, I'm doing this because I need to, to get to work on time or, do that. Just like you're talking about right now.
Yeah.
Right. So I think there is a large runway for growth. I mean, I think they have, they're in 95% of the U.S. cities, right? And Canada. Uber is all over the world.
They just bought Kareem, I think that's what it's called.
Uber did.
Yeah, Uber. Sorry.
Yeah. Lyft though has a lot of places it can go from here.
Yeah, for sure. They're just domestic North America.
Yeah. So if we say that the world has a need for transportation, I mean, I think there's definitely a they have the opportunity for growth for long term.
Yeah. Maybe this is a good place to bring this up too. Well, Yeah. Actually, I'll bring it up later. I think this topic is more fitting in the financial discussion. So we'll put that aside. So let's move on to the next bullet point. What does the company require a lot of capital and reinvestment to maintain its business?
So I think I don't think the answer is as clear cut as I would. They're already they say in 95% of the U.S.
Yeah.
So they kind of already have the infrastructure built out. But when we're talking about capital versus operating cash, when we start talking about the financials, I think you're going to see that they're not just a ride-sharing app, right? They're providing a bunch of services around this thing that are actually fairly expensive, right? In order to achieve the level of customer service that they've set out for themselves, they have to do a lot of things that are expensive.
Yeah.
And so I think what we are going to see in the future is, because I do think there is a path to profitability for them, but it's going to mean that their service is drastically different than it is today, right? These culture of values and things, the authentic brand that they talk about, that is going to have to go away because that they can't afford it in the long run, right?
Yeah. I think you and I had this conversation last night. I think it'll be interesting to kind of when we dig deep into the financials, it'll be really interesting to kind of see what they're really made of, number wise, and that what that means for the business itself.
Right.
Yeah. Okay. Any outstanding issues with relationships with customers, suppliers, employees, regulators, things like that?
Yeah. So I want to bring up. There's a guy who his name is he posts on the blog Naked Capitalism.
Yeah.
And he's talked a lot about Uber and Lyft. He's Hubert Horan is the guy's name who wrote a lot of these articles, and he's worth a Google to find it. And he's got it's like a 10-15 part series.
Can you spell his name?
Hubert Horan, and the website is called Naked Capitalism. And it's a great read because he actually kind of this guy's a veteran of the transportation industry. And so he kind of talks about this, because one of the reasons that they've been so successful is that they have a lot of hidden costs for their drivers, right? So we haven't talked a whole lot about the drivers yet.
That's interesting, yeah.
So let's talk about that for a minute, right? So let's say you pick up your car, right? So we've talked about this depreciation on the balance sheet as a, how that affects the business, right? So depreciation is basically using up an asset, right? So you buy a car, the moment you drive it off the lot, they always tell you it's worth less than when you paid for what you paid for it, right? Yeah. But then every mile that you put on it and every year that it goes, it's worth less, right? So what you're doing when you ride share with Uber and Lyft, right? You're a driver with one of these companies. You basically are depreciating your asset very quickly, the faster than somebody who's not doing that, right? But but that depreciation is a non-cash expense, right? You don't see
it right up front.
Yeah. Now you could, if you were like a financial business, what you would do is you would set aside a certain percentage of your earnings as a depreciation expense, and then use that to buy a new car, right? But people don't think that way, and so what you see is a lot of people will drive Uber and Lyft, and then after 6 months they'll realize, my God, I had a $2,000 car, repair, because I was driving the car so much.
Yeah.
Or I had, I'm spending a lot of money on gas. I'm spending a lot of money on this. So yes, my take-home pay is, was $150 for the night, but then I also spent a bunch of money on gas. And then in the future, I'm going to have to spend money on.
Yeah, that's the part that a lot of people are missing, the future part, because I think people run on cash-based accounting.
Right.
People don't run on accrual-based accounting.
Correct.
And that's to a lot of people's detriment.
Right.
In this case specifically.
Yeah, and I think your car will last, 5, 6, 7, 8 years, right? So it may be you have a 2-year-old car or a 3-year-old car, you won't even notice, but then the car payment comes up. And you may not even be driving for Uber and Lyft, now, but you've basically wasted all of that,
Yeah.
So I feel like, and the irony of it is Uber and Lyft don't want old cars in their service, right? They want you to be driving the newest, latest, shiny thing, right? Well, that's where the depreciation expense is the highest, right? Because you get an older car, it depreciates less relative to the initial, amount that you paid.
Yeah.
So,
and they also, we'll talk about this more, but they also have like leasing service and things like that. So, for example, if I want to drive for Lyft and I don't have a car, I can just sign up with them, and then I can sign the whole lease with them, get a car, and then drive all in one, all within Lyft platform. So, we'll talk more about that in the financials part of the podcast. So that's kind of the checklist that we have for this episode 49. Do you have anything else that we want to talk about before we close this out and move on to financials and management and valuation?
So not really. I mean, I think I've been very harsh about this company. I'm not saying that they can't eventually turn a profit or something like that, but I just look at this business and I just see, I'm very skeptical, right? Every investment that you look at, you should be skeptical. I am more so skeptical because of kind of the way that they have presented themselves as this like sort of, we're the Silicon Valley unicorn startup, magic, comes out of our horn and we're the greatest thing that ever, lived. And I'm like,
it comes out of the horn.
And I'm like, you
levitate.
Bro, it doesn't work that way. It doesn't work that way, right? So you guys have to prove it, right?
Yeah.
And what I'm seeing doesn't, convince me. So, I'm curious to see how their tone changes in the next, in the annual reports and things like that.
Yeah.
Because it was very fluffy, right? Like, I don't know what other term, to use.
Yeah, it's very frothy, fluffy. Yeah, we'll see what happens. I mean, I think the public market scrutiny is going to put a lot of pressure on the management, and we'll see how it goes from here. But that kind of closes out our first episode of Lyft. All right, so we'll see you on the next one, episode 50. Thank you guys.
Yeah, thanks.